Maybe the lights would help. Yeah, the lights would help. No, I'll tell you. It's okay. All right. So, in the old days, you got a loan, you got a mortgage from a lender, which was probably a local firm. And you were responsible for paying that loan to that lender, and that lender was responsible for collecting. And, yeah, still can't see it. Okay, sorry. Don't worry. Don't worry. Now, beginning about 15 years ago, the financial system of the United States began to change in an extremely dramatic way. And a number of things happened, the most important of which that's pertinent to the financial crisis is that a number of previously distinct institutions and segments of the industry became very tightly integrated via the securitization food chain. So no longer did a mortgage stay with a local lender. What happened was lenders sold their mortgages to investment banks. Investment banks then packaged them, often along with many other forms of debt, including private equity and leveraged buyout loans, car loans, student loans also were packaged in this way. Credit card debt was packaged in this way. Commercial real estate loans, commercial mortgages were packaged in this way. They were packaged together in large quantities and then sliced in complex ways. Those slices were then rated by a rating agency, and those slices were then sold to investors all over the world. And this went from being initially a relatively small activity 15 years ago to being a gigantic activity involving the majority of the total debt market, at least the total private debt market. Sovereign debt, like treasury bonds, was typically not handled in this way. And that securitization food chain basically unleashed, or the use of that securitization food chain unleashed what became the bubble. So these are the institutions who were involved in the securitization food chain. And this system came to be the majority of the revenue and profits for the financial system in the United States for about a 7-8 year period. And it's an extraordinary story. Okay, so by the time this system evolved, the financial system in the United States, financial sector, had also concentrated remarkably from its existence 30 years ago. 30, 40 years ago, there were 50, 75 different investment banks. 50 years ago, Morgan Stanley had maybe 100, 150 employees. Goldman Sachs, Lehman Brothers, many others, Salomon Brothers, many that don't exist now. These were small-scale private partnerships, with the exception of Merrill Lynch, which was early on a large retail firm. The investment banks typically had a few hundred employees and maybe 10, 20, $30 million in capital. They were private partnerships, and the capital was the partner's capital. And it's obviously very different now. By the time the bubble started, there were 5 major investment banks left as independent firms, and then there were a few other investment banks which were part of larger financial conglomerates, the 2 largest in the United States being Citigroup and JP Morgan. There were several other European financial conglomerates that had significant investment banking operations, Deutsche Bank, for example. There also evolved an insurance sector, which included 3 principal firms, 2 of which you've probably never heard of, Ambac and MBIA, both of which are pretty much bankrupt right now, and another which you definitely have heard of, which is AIG. And these firms provided insurance for the debt and the complex derivative debt-based products that were in the securitization food chain. Okay. So now the bubble. No, let me finish by making a brief comment about the buyers and holders. One of the surprises to a lot of people, not to everybody, but surprises to people in the government, surprises to many people outside the United States, to many random observers about the financial crisis was that it turned out that a lot of this stuff that turned out to be very bad had been purchased and or held by the banks themselves that had been packaging and selling it. Sometimes directly, sometimes held, owned literally by Merrill Lynch, literally by Citigroup. In other cases, by hedge funds or structured investment vehicles that they controlled, and which permitted them to keep these products off their balance sheets, but which really did form part of their real balance sheet because they had to take these products back if they failed. And that's what led to the destruction of these firms. So why would they do that? And we'll come back to that in a minute. So this system was in place and moving quite briskly beginning about a decade ago, which is when the bubble began. In about a 5-year period, we went from a kind of normal situation in 1999, 2000, 2001 to, by 2005, 2006, a completely crazy situation. And I'll show you a few statistics. Oh, you might not be able to see them. We'll see. Okay. Several things drove the bubble. The Bush administration and the Federal Reserve both had a major role in doing it. The Bush administration, through essentially Keynesian spending, very high deficits, tax cuts, high levels of spending, and Alan Greenspan at the Fed kept interest rates extremely low, which made it very easy to borrow large amounts of money. Once the bubble started, because housing prices were going up so fast, that led to a kind of temporary fake economy that it's estimated accounted for a third to a half, maybe even more than a half, but I would say very close to a half, quite surely, of American economic growth during this period. So what was that? That was suddenly there were millions of mortgage brokers. Suddenly there were millions of real estate agents. Suddenly there was an enormous amount of housing construction because housing values were going up so much. And people were making paper profits on their houses, borrowing against those paper profits, and spending more generally throughout the economy. So the construction sector, the real estate sector, and of course the financial sector grew very sharply during this period. Now, no, you can't see that. Okay, mortgages, total mortgage lending quadrupled in about a 5-year period, from 2001 through 2005. Mortgage lending roughly quadrupled. And I can't even see what that is myself. Oh, it's subprime loans. Okay, so mortgage lending overall increased extremely sharply, but what increased even more sharply was the lower tiers of mortgage lending, which had previously been a relatively small fraction of the mortgage market. Subprime loans became very large business and something like a third of all mortgage loans. And that was something that many people noticed and worried about even at the time. Then this, which you also can't see either, this is my fault, I'm sorry. The red bars, the blue bars underneath are the earlier leverage levels, 2003 leverage levels of the investment banks. The top of the red bar is the 2007 leverage levels of the investment banks. In 2004, the investment banks lobbied the Securities and Exchange Commission very heavily and successfully to lift their leverage limits and allow them to borrow much more. And in the case of Lehman Brothers, Lehman's leverage ratio got up to 33 to 1, meaning that a 3% decline in the value of its assets would leave it insolvent, which in fact it was. So the leverage in the system grew very sharply, not just in the investment banks. That's one illustration. There was a lot of leverage elsewhere in the system as well. So in 2006, basically housing prices stopped rising because the home ownership rate in the United States had gone from 62, 63% to 69, 70%, historical high. And the financial system had basically run out of people who were willing to buy houses, even under bubble-like conditions. And when that happened, appreciation in house prices stopped, began to reverse, and then everything started to unravel. The first thing that unraveled was the securitization food chain itself. So the lenders could no longer sell any of their low-quality loans, even after they'd made them, after they'd signed contracts for them. They could no longer sell their low-quality loans to the investment banks. The investment banks were holding hundreds of billions of dollars of loans that they had already purchased and were in the process of warehousing, packaging, and selling, and suddenly they could no longer sell those. The structured investment vehicles and hedge funds, which had purchased them, suddenly found that they were no longer able to borrow money and that the value of their assets was beginning to decline, and as delinquencies rose, income was starting to decline from them. And then came the real crisis. And so the real crisis started when Bear Stearns collapsed in March of 2008. Then in September, early September, Fannie and Freddie were taken over by the federal government. And then in a 3-day period, September 15 through 18, roughly, of 2008, Lehman Brothers, AIG, and Merrill Lynch all collapsed. Merrill was sold to Bank of America for $50 billion over a 36-hour period. AIG received an $85 billion bailout, and Lehman Brothers went bankrupt. When Lehman Brothers went bankrupt, Lehman Brothers paper was held by many money market funds, and the money market started to collapse, and there were something like $150 billion of withdrawals from American money market funds in a 2 or 3 day period. And people began to, in a very short period of time, people began to quite seriously worry about whether they would be able to get their money out of their bank. The first time that serious people have had that concern in the United States since the 1930s. Lehman Brothers was also quite critical to the hedge funds and to the commercial paper market. And those two markets also started to collapse, again, quite rapidly. And then after that, the real economy. And for about a 6-month period, unemployment in the United States was increasing by about half a percentage point per month, which is historically unprecedented. I mean, even in the Depression, unemployment did not increase that quickly. This you also can't see, I'm sorry. This is if you could see it, it's a graph of the ratings of a bunch of CDOs that had been issued by Goldman Sachs. And I'll come back to Goldman Sachs later. Okay. So there are some interesting things about the administration's response to the crisis when it began. At first, the Bush administration was rather oblivious and pretended, and in fact seemed in reality not to believe that there was anything fundamentally wrong and that a crisis might be in the offing, even though many people had been warning it about that. And there are some puzzles about why that's true.